silver going to 200 without too much difficulty. Number one. Number two, silver's going to tag along with gold. There's no way gold's going to the levels I expect where silver's not along for the ride. You're not going to have $20,000 gold. We'll get there. It's going to take a while to get to $10,000 gold. We'll get to $20,000 gold, but that's not going to happen without silver going to 200 or higher. So, it's kind of hitching your wagon to the right horse, so to speak. So silver will go along with gold.
And the smart money is in gold and silver. And the smarter money is working with me on a global movement, a global sound money movement to get redeemable gold back in the system again.
Market projections indicate that silver is poised to reach $200 with relative ease, a move that is inextricably linked to gold's ascent toward $10,000 and eventually $20,000. The analysis suggests that there is no scenario where the yellow metal reaches these historic valuations without silver tagging along for the ride. This relationship is described as hitching your wagon to the right horse, ensuring that as the primary monetary asset climbs, its industrial and monetary counterpart follows suit in a powerful correlated rally. James Rickards, the best-selling author of Currency Wars, and Lynette Zang, CEO of Zang Enterprises and a prominent sound money advocate, break down the mechanics of this shift. They emphasize that smart money has already positioned itself in precious metals, but the smarter money is actively driving a global movement to restore redeemable gold to the financial system. This transition represents not just an investment opportunity, but a fundamental return to sound money principles where physical assets once again back the currency. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I always say hedge fund traders don't care about gold, silver, or coffee beans. They just trade. And so if you're a trader and you do a leverage bet on gold, it goes up 10% in 3 days, you probably want to get out of the trade and, mark it up towards your 2026 bonus. So that kind of volatility is normal, but it doesn't really tell us where to peak or anything of the kind. With that said, so what are the drivers? There are several. One is central bank demand. It's, we've talked about that before, but it's a big deal. They, from 1970 to 2010, central banks were net sellers of gold. Different central banks at different times, believe it or not, in the 1970s, even after Nixon suspended the convertibility of dollars for gold, the U.S. continued to sell gold. We sold about 1,000 tons over the course of the 1970s, got us from 9,000 tons in 1971 to about a little over 8,000 tons in 1980. Then we got the UK to do our dirty work. There are really technical reasons why the U.S. has not sold any gold since 1980. Probably don't have time to go into them. They're legal and has to do with when the Fed took the gold from the banks, but in the 1930s, the Treasury took the gold from the Fed. So they keep stealing it between themselves. But there are reasons to believe that, the U.S. has not sold any gold since 1980. You sell a little bit to the Denver Mint for coinage and get some more, but they've maintained that official level the whole time. There are reasons to believe that the U.S. cannot sell, not only is not a seller, but cannot sell legally. So put that to one side. The UK sold about a third, almost half of their gold in the late 1990s, 1998, 1999. They weren't very savvy traders. They sold at $250 an ounce, not $2,500, but $250 an ounce. Practically gave it away. That was Gordon Brown was the Chancellor of the Exchequer. You should see him around London, the Red Fort or different restaurants. So that's known as Brown's bottom. He managed to pick the bottom, a 30-year bottom of the market. He picked it and sold the gold. But even in the 2000s, Switzerland sold 1,000 ounces, and in 1,000 metric tons. Not ounces, 1,000 metric tons. And then there was an uproar in Switzerland. There was a referendum. It failed, but the people in Switzerland were to the point where they wanted a referendum saying that the Swiss National Bank could not sell any more gold. The referendum failed slightly, but the message was sent, and they have stopped selling gold ever since. That brings us to the IMF. The IMF sold 400 tons in 2010. Looks like 200 or so went to India. They never disclosed where the rest went. I'm pretty sure it went to China.
I know that you've often heard me say that sound money, physical gold, physical silver, is above all governments and central banks. Well, today I'm going to show you why I say that and truly what that actually means. Because sound money, physical gold, again, physical silver is universal, decentralized. And when you hold it, it's private. Something that's very important in this day and age where really we have basically no pride. But you know, gold and silver were the original money, constitutionally supported. Only states, the only money is gold and silver. So this is constitutional money pre-1965. And it had these characters. Money needed to have these characteristics. A unit of account for fair pricing, a medium of exchange for barterability and trading. If I give you this, you'll give me that. A short-term store of value for current fair payments, so you're fairly paid for your labor, and a long-term store of value so that no matter when you use that money, you're always fairly paid for the value of the labor that originally created it. We talk about this regularly. So real money, sound money, has these four functions, and every single portfolio needs to have a foundation in sound money. No matter whatever else you do, that is proper diversification. But why is gold and silver above central banks and above government? Well, because you hear me say this all the time, but I'm going to show you. It's used in every single sector of the global economy. So that's really what puts it above that. It's above all government, all central banks, because of that supply and demand factor. There is a finite amount of physical gold and silver. There's an infinite amount of money printing.
Short-term market volatility often distracts from the massive structural shift occurring in global reserves. After decades of net selling, exemplified by the UK's ill-timed liquidation at market bottoms, central banks have ceased suppressing gold and are now aggressively accumulating it. This pivot signals a return to sound money principles, where physical gold and silver are valued for their finite supply and independence from government printing presses. Unlike fiat currency, which is subject to infinite dilution, physical metal serves as constitutional money that offers privacy, decentralization, and a permanent store of value. This unique status places it above the banking system, making it the essential, non-counterparty foundation for preserving wealth against the infinite expansion of paper debt. Let's get back to the interview.
One of them is that silver is a major technological industrial. Gold's actually not good for very much except money. It's probably the best form of money, but the industrial applications of gold, they're extremely limited, very, very specialized. I've visited a number of the biggest refiners in the world, and I talked to people about this. I once asked a guy, he was the head of Argo Horace, one of the biggest refiners in the world. Could he make 5 nines? 4 nines gold is 99.99% pure gold, and there's a process for it. And I saw it kind of play up. I said, just out of curiosity, could you make 5 nines? He said, we can, but it's not worth it because it's the added expense and energy inputs and things you have to do to get there don't give you more value in gold terms relative to 4 nines gold. It's just not worth it. Except for certain, he said, ultra thin wiring. If you want that, we can do it, but it's really, really specialized. But basically, coating a space helmet maybe, but basically gold is not good for much other than money. Silver is different. Silver is used in wiring, electronics, catalytic converters, weapon systems, all this AI, frenzy and building these massive data centers and the processors. That all requires a certain amount of silver. Yeah, other things too, cobalt and copper, galore, silicon and rare earths, they're all needed as well. But silver is an input to all that. So silver has a precious metals vector and an industrial input vector. They don't have to go in the same direction. You could have a bad recession and an AI blow up where industrial demand is going down and precious metals going up, or vice versa. But at the moment, they're both going up. The industrial demand is huge and the precious metals demand is huge. And there are other things going on that are, non-transparent. You hear a lot of rumors. Some of them have some merits, some not. You hear about enormous physical demand for silver that cannot be met or satisfied by paper silver contracts. People who sold silver on paper, they're being called, say, hey, deliver the silver. It's like, oh, wait a second. I thought we had a trade here. You want silver? Well, that's different. I got to go find it. So there's enormous demand coming from all over. I've heard reports, I can't verify them, that China is hoarding silver. Why would they do that? Well, the answer is what we just discussed. They're trying to beat the U.S. in the AI race. So the open trading relationship between China and U.S. is pretty much off, at least in that sector. Maybe soybeans are moving, but not too much in the AI, NVIDIA chip world. So China knows that if they're going to keep up with the U.S. in electric vehicles, where they're probably ahead, AI, they're not ahead, but they're trying to catch up. Military applications, same thing. They're going to need a lot of silver. And so they are hoarding it. They're just buying it like crazy and putting it away in inventory, basically, for future use. And then you do hear a lot. This is another one of those narratives that doesn't hold up to examination. You hear people say, well, the physical longs and silver futures, so COMEX or London Metals Exchange, are massively greater than the amount of silver in the warehouse, and they couldn't possibly meet that demand, and they're going to default.
Silver is rapidly decoupling from gold due to its irreplaceable role as a major technological input, powering everything from AI data centers to advanced weapon systems. While gold remains the ultimate form of money with limited industrial application, mostly confined to specialized uses like space helmets, silver drives the modern economy. This dual demand vector, combining monetary safety with industrial necessity, is creating a perfect storm as global powers like China reportedly hoard massive inventories to secure their supply chains for the electric vehicle and AI arms race. The market is witnessing a potential breakdown in the paper derivative system, where physical contract holders are demanding delivery of metal that simply may not exist in the warehouses. This strategic stockpiling by Eastern powers suggests a geopolitical pivot, forcing a squeeze on paper shorts who cannot locate the physical inventory they sold. As industrial consumption accelerates alongside monetary panic, the risk of a COMEX default grows, potentially marking the end of price suppression. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.